General insurance is only made for only 1 year, whereas the life policy is made by number of years. 50% in case of fire and accident, 100% in case of marine. Accepted means paid, ceded means received. Ceded should be deducted, accepted should be added. Premium schedule number 1, claim schedule number 2, commission schedule number 3, operating expenses schedule number 4. Hello my dear student, I am Dr. B.S. Subramanya, called by name Dr. B.S.S., Professor in Commerce and Management, Vidhyaashram First Grade College, a Temple of Excellence, MYSURU. I am going to hand Corporating Accounting 2, 4th semester, Unit 1, Session 1 in favor of BCom. It goes in favor of accounting for general insurance company. There are two types of insurance companies. One is called life insurance company, another is called general insurance company. General insurance goes in favor of fire, accident and marine, whereas a life insurance goes in favor of life insurance company. Entire life is going to be insured here. It is a general means in case of fire, in case of accident, in case of marine insurance it will go, whereas the life is the question of a life of a customers, or we can say personality. We will go with the life of the insurance company, that is will deal in the next session. It is only general insurance we are going to touch. And I will explain what I mean that. So, it's an introduction class, no, just an introduce, and they will do the one problem on general insurance company. General insurance is not made on the life of the customer. It is not made on the life of the customer. It is made on the certain event to be happen. It is made only for 1 year. Certain event. It may be accident. It may be fire. It may be something which is a particular event we made that. If the accident takes place, if there is a fire takes place, that event is made. That event we got as insurance for 1 year. This is insurance for only for 1 year. If nothing happens in the 1 year, it has to be renewed for the second year. It is not for a long time. It is not for a long time. It is only for 1 year. Then, general insurance made in case of fire, accident and marine. Not the life in case of fire, in case of accident, in case of marine. Every general insurance company has to keep aside about 50% of net premium in case of fire and accident, 100% in case of marine insurance. After what's called, we got the net premium. Out of the net premium, full money should not be utilized. Out of that, 50% has to be kept aside in case of fire and accident, and 100% in case of marine as a safe regard, reserve for unexpired. What do you mean that? Reserve for unexpired 50% of the net premium of the fire or accident, whereas in the case of marine, you have to keep 100%. This is made only for 1 year, and the particular event should be happen. We'll move on. Here, if there is any difference between the life insurance and the general insurance, but we are doing the general insurance, but comparison has been taken place between the life insurance and the general insurance. What is the first difference? It is made on the life of the customer. Life insurance is made on the life of the customer, but it is not made on the life of customer. It is made on the certain event. The event may be accident or fire. It is on the life of the customer. It is on the event. The event may be fire or accidents are concerned. Then policy mature of completion of period or death of the customer. So policy has been made for 25 years or 30 years. Once the mature, it can get back, or the death of the customer, whichever is earlier. Either policy mature or the death of the customer, whichever is them. If the customer dies, the money goes to the nominee. The money goes to the nominee. Here, policy mature, only events occur, which are, if we made the accident, fire accident, if there is a fire, then the compensation is there. If there is an accident, compensation will be given. Unless no money will be given to you. How it should be happen within the 1 year. If it does not happen anything, no, whatever the premium you have been paid goes in favor of the insurance company. So next year you have to, once again you have to renew. But after the expired period, if the accident takes place, no money will be paid from the insurance company. Within that limited time, if anything happens due to fire, due to accident, compensation will be given. Then, number 3, policy is made for more than 1 year. The policy may be 5 years, 10 years, 15 years, 20 years, 25 years, 30 years. But this policy is made only for 1 year. General insurance is only made for only 1 year, whereas the life policy is made by number of years. Then, life insurance fund is opened here. In case of life insurance, what's called life insurance country, life fund will be opened here. Here, life assurance fund is not at all opened here. Then 5th, bonus is given by company to policy holder. Here, the bonus will be declared to the policy holder. Here, bonus is not given by company to policy holder. So, generally, this question will be asked. Maybe famous question here. First is, it is made on the life of the customer. It is made on the what's called the particular event. The event may be accident, fire, or something. So, particular event should be happen. Policy matures. If the policy matures only, then only can get back the money, or the death, whichever is earlier. If a policy is made by 30 years, once the 30 years is over, you'll get back your money. Or death, whichever is there. If the particular customer died, the money goes in favor of the nominee. Who he made the nominee of whom? Generally wife. So it will go, or what are the relatives he made? So it will go to the nominee. In case your policy mature, only the events happen. If the what's called your insurance is made for fire, the fire should be take place. If the event was called, if you make the insurance for accident, the accident takes place, then only will get back the money. Then policy is made then more than 1 year. It is not for 1 year. It's more than 1 year, 2 years, 3 years, 5 years, 4 years, 20 years, 25 years, 30 years. Here the policy is made only for 1 year. Here life assurance fund is open. Life assurance fund is not open. Bonus is paid to policy holder, whereas bonus is not paid to policy holder. This is a little bit difference between the life insurance and the general insurance. Then we'll move on. So this is a format of the revenue. They will ask for 10 marks, revenue account of the general insurance company. What are the format of the general insurance? First, the premium earned. Whatever the premium earned is a income. Then the expenditure are claims incurred. What are the claims paid to the particular customer? Commission paid, operating expenses, total of B. Total of A, total of B, surplus of deficit, A minus B. If the income is more, if the expenditure is less, it's called surplus. If the expenditure is more, if the income is less, it's called deficit. This format you have to fill up. What is the first one? Schedule number 1, premium. Schedule number 1, expenditure claims incurred. Schedule number 2, commission. Schedule number 3, operating expenses. Schedule number 4. You must remember premium. Schedule number 1, claims admitted and paid, schedule number 2. Then commission, schedule number 3. Operating expenses, schedule number 4. Which are the 4 schedules are? One is the premium, is the income, schedule number 1. Number 2, claims is the schedule number 2. Commission, schedule number 3. Operating expenses, schedule number 4. For this, you will go very detailedly. What are the things it is got in the schedule number 1? Schedule number 2, schedule number 3, and schedule number 4. Then only we can enter to problem. We'll move on. This is the schedule number 1. Premium, you see, less reinsurance premium should be deducted. What is reinsurance premium? If somebody comes and make the insurance for rupees 1 crore, so he is going to pay the premium. He made the insurance for a particular article for gold for 1 crore. He will pay the premium. But we have got a fear, if some events happen, you have to pay back 1 crore, no? So what the insurance company will do, you will take the our company is A company, will take the help of the B company. Out of 1 crore, 50 lakhs is insured by us, another 50 lakh insured by another company. Whatever the premium the customer pays, half of the money goes to B company, half of the money comes to us. So whatever the money goes, that is called reinsurance premium. We have to pay, means your premium amount will be reduced. You receive about rupees 1 lakh premium. Out of 1 lakh, I receive only 50,000. Another 50,000 goes to another company. That's called reinsurance premium. So net premium, add opening reserve for, if there's opening reserve for unexpired risk, that should be added. Add opening additional reserve should be added. Less closing reserve unexpired, 50% in case of fire and accident and 100% in case of marine of net premium. Then less closing additional reserve, existing plus addition. If the problem says the additional reserve is made, existing plus additional, maybe 5% or 6%, in accepting what? Already you are got existing additional reserve. You already got the additional reserve existing plus addition of 5% or 10% of the net premium, they say. If this for existing does not arise, directly percentage on net premium today. So what's the procedure? First is the premium minus the reinsurance premium should be deducted. Difference is called net premium. Add opening reserve for unexpired risk. Add opening additional reserve less closing reserve for unexpired risk. 50% in case of fire and accident, 100% in case of marine. Then less closing additional reserve if the problem says existing plus additional, you have to make, the difference will come. Then second one, schedule number 2, claims. Claims paid minus outstanding claims at beginning means after last year, add outstanding claims at the end of the current year minus reinsurance recoveries. If any recoveries has been made, that should be deducted. First one, claims paid minus claims of the last year, claims of the current year should be added minus reinsurance recovery should be deducted. Number 3, commission. Commission paid, accepted means paid. Accepted means paid. Reinsurance. Ceded means received. Ceded means received. Accept means add. Already you have accepted the commission. Further commission. Ceded means we received the commission. That should be deducted. Then management schedule number 4, operating expenses. Here management expenses, add legal expenses. If there is outstanding of the current year is there, that should be added. Outstanding of the last year is there, that should be deducted. So management expenses, add legal expenses, add depreciation. This is a procedure. Now, hope you understand the particular format. This is very important format here. See that? This is important. Premium minus reinsurance premium should be deducted. It is called the net premium. Less add opening reserve for unexpired risk. Add opening additional reserve. Less closing reserve for unexpired risk. 50% in case of fire and accident and 100% in case of marine. Minus closing additional reserve existing plus addition you have to make. Then you have a claim paid, outstanding claim of the beginning means of the last year, means outstanding claim of the current year minus reinsurance recoveries. Commission paid, add commission on reinsurance. Accepted means paid, ceded means received. Then operating expenses means management expenses, add legal expenses should be added, depreciation should be added. This is a particular format you have got. We'll go to first problem. Simple problem you are going to solve. The books of Sangeeta General Insurance can provide the following particular provision for unexpired risk. This is a beginning, they should be added. Additional reserve should be added. You know the format. First is the premium, second is the claim, third is the commission, fourth is the operating way. For a premium, this should be added. This should be added. Outstanding claim beginning of the year, that should be deducted. At the end of the year, that should be added. Claims paid will come under schedule number 2. Reinsurance premium should be deducted. Reinsurance recovery should be deducted from the claim. Premium will come in schedule number 1. Interest and dividend won't come. It will go to profit and loss account as a income. Income tax also won't come. It's an expense. Legal expenses will come in operating expenses. Commission on reinsurance ceded should be deducted from the commission. Commission on direct business will come in schedule number 3. Then commission on reinsurance accepted, that should be added. Management expenses will come in operating expenses. In addition to existing addition means 5,60,000 plus 5% of the premium. We'll move on here. Premium 28 lakh minus reinsurance premium should be deducted. It's a net premium. Add opening reserve for unexpressed. Add opening additional reserve less closing additional reserve. 50% of the net premium. Your net premium is 25 lakh 20,000. On that 50% work out 5 lakh 60. This 12 lakh 60,000 less additional reserve existing plus 5% of the premium. Say what's your existing? 5,60,000 plus 5% of 25 lakh, 1,26,000. It will work out 6,86,000. The total will come 21,84,000. Then month claims paid is 11,20,000. Outstanding claim at the beginning should be deducted. Claim at the end should be added. Reinsurance recovery should be deducted. The balance goes 11,27,000. Then commission on insurance, we have paid the commission how much? 1,75,000. Accepted means paid. Ceded means received. Ceded should be deducted. Accepted should be added. It will work out 1,68,000. Commission on direct business 1,75,000. Commission on reinsurance 28,000. This is nothing but minus 35,000 should be deducted. 1,75,000 plus 28. This is 1,75,000. Plus 28,000 minus 35,000, 1,68,000. So this should be deducted now. We will move on to schedule number 4, operating expenses. Here we got management expenses 6,30,000. Add legal expenses 21,000. Total will come 6,51,000. We'll put in the same amount in the format. So it's a revenue account. I told you no. Schedule number 1 is premium earned is 21,84,000 as per the working note. Then this is a total of A. Then expenditure claims incurred schedule number 2 11,27,000. Commission schedule number 3 1,68,000. Then operating expense schedule number 4 6,51,000. Totally it will work out 19,46,000. So total of A is income, total of B is expenditure. So operating profit or loss, operating profit A minus B from 21,84,000. You have to take 19,46,000. It will work out 2,38,000 is the operating profit. So this format you have to learn very clearly. Premium schedule number 1. Claim schedule number 2, commission schedule number 3, operating expenses schedule number 4. While you're doing the premium, you must remember premium less reinsurance premium, add opening reserve, add additional reserve, minus closing reserve for unexpiries, minus closing additional reserve. That should be done. Then regarding these claims are concerned, accepted should be added, ceded should be deducted, recovery should be deducted from the claim. Commission accepted, commission claims no. Regarding the commission, accepted, see that commission accepted should be added, ceded should be received. Under the claims, last year claim should be deducted, current year claim should be added here. In the claims, last year claim should be deducted, current year claims should be added. If there is any recoveries, that should be deducted. Regarding the commission paid, accepted should be added, ceded should be deducted. I will repeat, for a commission, accepted should be added and ceded should be deducted. Operating expenses, management expense will come, depreciation will come, legal expenses will come. So you have to remember the format. Once you know the format, premium earned, then your expenditure are claims incurred, commission. Regarding this, no, we must be very, very careful. Claims, last year claim should be deducted, current year claim should be added, legal expenses should be added. Regarding the commission to the business, commission paid minus outstanding last year commission should be deducted. Here commission claims no, claims incurred last year claim should be deducted, current year claim should be added. Regarding the commission, seeded should be deducted, accepted should be added. For a commission, seeded should be deducted, accepted should be added. Operating expenses, management expense should be shown separately. Then the total expenditure, total of A, total of B, whatever the difference comes, that is the surplus. 10 marks question, definite question will come from the examination of point of view. If we solve about 4 or 5 problems, all the problem will be one and the same. In the next session, we'll go to one more problem. Same type of problem will come, but you learn the format very well. What the format said: premium schedule number 1, claim schedule number 2, commission schedule number 3, operating expenses schedule number 4. Claims, last year claim should be deducted, current year claim should be added. Regarding the commission, commission paid minus seeded should be deducted, accept should be added. I'll repeat: commission, seeded should be deducted, accepted should be added. And then operating expenses, management expenses, here we get management expense. Operating expenses is nothing but management expense will come, legal expenses will come, depreciation will come. Learn the format very well. We'll have in the next session some more problem about the revenue account of it. May be in case of fire or accident are considered. I told general insurance is made only for 1 year. Life insurance is made for number of years. It is made for a particular event. It is made for a particular, the event may be fire or accident. Hope you understand. We'll meet in the next session with some more problem about the fire and accident. Till then, goodbye. Meet in the next class with another problem. This is a problem for 10 marks, definite problem from the examination point of view.